Welcome to the IB Business and Management course, delivered in style, online. I'm Mr. Burden. I'll be running you through 3.3 today. That's working capital, our third section, our third topic in our accounts and finance section. I do hope you're watching this embedded in ibbusinessandmanagement.com, the perfect online place to learn everything you need to know about the IB Business and Management course. Right, enough of a plug for that. Let's get going. 3.3, working capital. Pleasure to have you with me today. Hope you learn something. Right, cash is often referred to as being the lifeblood of a business. Cash comes into a business, cash flows out. If there's not enough cash on hand, a business is going to run into trouble producing their product. Money comes in, money is received typically from sales of goods and services. We call this a current asset. It's only one of our current assets. Current assets, we have got cash, we've got stock, and we've got debtors. And essentially we're just talking about cash at the moment. The most liquid of our assets. Our most liquid current asset is cash. Liquidity defined as how easily an asset can be turned into cash. Stock that we have, that we produced, we can turn it to cash, but it may take some time. Debtors, they're a liquid asset, but again, debtors can take some time to front up with the money that they owe. Great little video here. Sit back, take some notes.
Working capital is a measure of a company's financial strength. Pete is thinking about investing in the automotive industry, and he has his eye on two companies, Arthur's Engines and Joe's Motors. Pete calculates the working capital for each company. Arthur's Engines has $200,000 in current liabilities that the company must pay this year, and $320,000 in current assets that can be converted into cash in less than a year. Pete subtracts current liabilities from current assets for both companies and discovers that Arthur's has $120,000 in working capital. This means the company can easily pay down its short-term liabilities or debts using its current assets. This is a sign of a profitable and efficient business. Joe's Motors, on the other hand, has $400,000 in current liabilities and only $360,000 in current assets, meaning the company has a working capital of negative $40,000. Negative working capital suggests that Joe's may have trouble paying its short-term debts. Joe's might be forced to sell an asset or raise more capital through long-term debt like a bond. Or, in the worst case, the company could go bankrupt because it can't pay what it owes. Because of Joe's Motors' negative working capital, Pete chooses Arthur's Engines as an investment. Working capital helps investors judge a company's financial health and future prospects. But no single measure tells the whole story. Working capital is one of many metrics investors use to evaluate a stock.
Now it's time to introduce you to the working capital cycle. A business must have some cash on hand which they can use to pay their staff, buy their raw material, and use labour and these raw materials to produce a good. Sell these goods, customers will pay cash hopefully, and that cash can then be used to manufacture, produce more goods and services for sale. The working capital cycle. Now, working capital, sometimes referred to as net current assets, that's the money available for the daily running of a business. In accounting terms, it's defined as being current assets minus current liabilities. But in essence, essentially, working capital, just the funds that are available for a business to pay its immediate costs and expenditure, those running costs. It's electricity bill, it's staff wages, those raw materials, it's suppliers, everything they need to be able to produce what they produce. Right, the working capital cycle and a little bit more debt now. So cash, we turn that into materials and stock. Those materials and stock we use to produce what we produce. We then sell our goods and services. Perhaps we do this on credit, and finally when our creditors pay up, we can receive some more cash and use that cash, buy some more materials and stock, operate our equipment, our factories, our businesses, produce our goods and services, sell it on credit again, turn it into cash, buy some more materials and stock, and so on and so on. The working capital cycle. Very important to know, important to be able to discuss it. Working capital, that accounting definition, current assets minus current liabilities. We need to be able to define both current assets, resources that belong to the business that are intended to be used within the next 12 months. So it's a resource, something that the business owns, and we're talking about a time frame of 12 months. 12 months is a key time frame for current liabilities as well. And this is money that a business owes that needs to be repaid within those next 12 months. Cash and overdrafts, creditors, debtors, stocks, and tax are all classic examples of current assets and current liabilities. Overdrafts, creditors, and tax being current liabilities, cash, debtors, and stocks, current assets. The only thing students get a little bit confused about sometimes is between creditors and debtors. Creditors, you owe the money to. Debtors, they owe you the money. Now, there's often a delay between paying for the cost of producing a good and receiving the actual cash from the sale. And in some instances, this can be quite extreme. For example, a property developer who's building a new subdivision, they're going to have to front up with quite a bit of initial cash and quite a lot of cash outgoings for a substantial period of time. The land needs to be developed, new roads put in, driveways, the housing needs to be constructed, landscapers need to come in. All of these things before the properties can be ready and sold. This can take a long time, perhaps up to a year, before they can start selling their property and start getting some cash flowing back into the business. We need to differentiate between what is cash and what is profit. They're definitely not the same. Now, it's common, or reasonably common, for a profitable business to run out of cash. So a business can be profitable, but it can be illiquid. It can run out of cash. Whereas a loss-making business, they can have positive cash inflows in the short term and make a loss in the long term. A quick example to run you through the difference between cash and profit. Alia, she owns a fine foods store, a specialist delicatessen. Now, in the last month, she bought $500 of fresh goods from a supplier who offered her 1 month's credit. 1 month's credit. She hasn't had to front up with that $500. During the course of this month, the goods have been selling, but they've been selling slowly, and she was forced to cut her prices several times. In the end, from that $500 of fresh goods that she bought, in the end she was only able to sell them all for $300. $300 paid in cash by her customers. So we can see for that month she's had a positive cash inflow. $300 came into the business, no money left the business, but we can see it's definitely not profitable. So profit or loss, she lost $200. Even though she's not paid for the goods, they're still recorded as a cost. Now that's key. Recorded as a cost. Profit, revenue minus cost. Straight away they're recorded as a cost, and it sinks her into being unprofitable. But whereas the difference between a cash outflow and inflow, she had a positive inflow of $300 because she hadn't yet had to front up and pay her supplier. So positive cash flow during this month, even though she made a loss on them. The difference between profit and cash. Cash, not the same as profit for this business. Sometimes it is, but often it isn't, and the IB Business and Management course likes you to be able to distinguish between both. Cash flow forecasting. This is a key technique to learn in this 3.3 section. Working capital. We need to be able to construct a cash flow forecast from given information. A typical structure looks something like this. You'll have to create it often. And you're going to put months along the top there, and you're going to look for inflows, cash inflows and cash outflows. The information will be provided. You just need to construct the table and plug in the information. Now, opening balance, information will be given here. Money in the bank at the end of June, $5,000. Money at the end of June becomes the opening balance for the start of July. Plug it in. We next need to be able to identify the types of inflows. Now, the types of inflows that we can identify from the information given in our exam questions, we'll be able to plug those into our table. Cash sales revenue, July through to December, we're selling significant amounts each month. We'll just put those into the appropriate month. So cash sales revenue, July 6,000, August 5,000, September 6.5, October 6,800, November 7.5, and December a whopping 9.5 thousand. Looks like we've got some additional income coming into the business here that's not created from cash sales. November rental income of $4,000. Simply under other income in November, that $4,000 goes in. Cash inflows done, dusted. Moving on to cash outflows now. The purchase of new stock to sell. So we've got to buy in stock before we can sell it. Looks like every single month, July, August, September, October, November, December, we are buying in stock to sell. Just put them in the appropriate column. A purchase of stocks. Bang, bang, bang. Staff wages of $3,500 per month need to be paid. A cash outflow. Plug them in. And there's some additional costs here as well. All other costs. This will be the electricity, the rent, etc., etc. So all other costs, $2,000 a month. October and November a little bit different, a little bit less, $1,800, and December a little bit more, perhaps for whatever reason, a little bit more. All we're going to do is use that information, plug it into the other costs section, into the appropriate monthly column. And we have our inflows, outflows identified and placed in the table. That's all the information that the IB Business and Management exam is likely to provide for you. You need to go and be able to complete the rest of the table. We'll start with total cash inflows and we'll just sum these month by month, and it's going to be very easy. November's the only time where we have to do a little bit of maths. So July, total cash inflows are 6,000. In August, they're 5. September, 6.5. October, 6.8 thousand. And November's the only month we've got to do some summing for our total cash inflows. They turn out to be $11,500. Total cash inflows identified, summed, moved to total cash outflows. And again, we just sum our total cash outflows, outflows to get our total cash outflow. Total cash inflows per month, total cash outflows per month, sorted. We can move on to net cash flow, which is simply our inflows less the outflows coming in. Now, it's standard convention to put any negative numbers in brackets. So if you see a bracket surrounding a number, it indicates that it's got a negative value. And straight away we'll see we'll have a negative net cash flow for July. 6,000 of inflow, 8,000 of cash outflows, leaving us with negative 2,000. August, 5,000 minus 7.7 will give us negative 2.7. September, it's still negative. We've got 6.5 coming in, 8.2 leaving. October, negative again, 6.8 total cash inflows, 8,000 in cash outflows. A negative cash flow for that month of 1,200. So you can see the business is struggling. It's borderline. Other rental income comes in and saves it in November. Total, our net cash flows for November turn positive again, and they're slightly positive again in December with those increased sales numbers coming through. Almost there. All we need to do now is calculate the closing balance and transfer that through to the opening balance of the following month. So in July we started with $5,000 and we had net cash flows of negative 2,000. So our bank balance would have been eroded and leaving us with only $3,000 in the bank at the end of July. End of July closing balance transfers through to the start of August, $3,000. We lose in net cash flow in the month of August, 2.7. So that just leaves us $300 at the end of August. Getting into trouble now. September, our opening balance, $300 in the bank. And a closing balance. We're into overdraft territory now. So $1.4 thousand we owe the bank. That transfers through to the start of October, our opening balance. Deeper into the red now, deeper into our overdraft. At the end of October, we've got a negative balance in our bank and we lose additional cash as well. So at the end of October, our overdraft's extended to $2,600. That's in the red. That's money we owe the bank, and that transfers to the start of November. Opening balance. At the end of November, we finally turn positive again. We've got a net cash flow of $3,200, which cancels out our overdraft, puts us slightly into the black. End of November, our closing balance of $600. Transfer that through to the opening balance at the start of December, $600. Add the $500 in net cash flows for December, and we've got a closing balance at the end of the year of $1,100. So simple enough once we've got the structure of the cash flow forecast in our brains. So the structure is important. You learn that plugging in the numbers is relatively easy. The calculations are dead easy. The structure is what you will have to practice. Right, steps quickly. We've run through them already. We're identifying what's leaving the business, so what's coming in, cash inflows. What's leaving the business, our cash outflows, identifying both those sources. We need to calculate the total inflows, calculate the total outflows. This will leave us in a position to calculate our net cash flows. Remember, that's total cash inflows minus total cash outflows per month. So calculate a net cash flow for each month. Once we've done that, we can subtract that or add that to our closing balance and transfer the closing balance to the opening balance of the following month. Easy. I'm surprised students get it wrong all the time. Alright, just quickly run through the advantages and disadvantages of cash flow forecasting. Common enough IB Business and Management working capital type exam question, especially after performing a cash flow forecast. Okay, by showing periods of negative cash flow, plans can be put in place to provide additional finance. So an overdraft can be arranged or owner's capital can be injected into the business. If it looks like our negative cash flow is going to be too great, then we can put plans in place for reducing this negative cash flow, so we can cut down on our purchase of materials, perhaps delay those purchases for a little bit, arrange some credit terms, stop our large ticket capital expenditure.
Show me.
And any new business proposal is never going to progress beyond the planning stage unless our investors, our bank managers, the people we need to tap for finance have access to some sort of cash flow forecast. Those were the three main advantages. Let's have a look at disadvantages quickly.
Show me.
Mistakes can be made in preparing the revenue and cost forecast. Remember, it's just a forecast, and the less experienced the entrepreneurs or the staff are that you have constructing these, forecasting these, the less likely they are to be accurate.
Show me.
Unexpected cost increases occur all the time, and these can flow into inaccuracies coming through in a cash flow forecast.
Show me.
Wrong assumptions can be made when estimating the sales of the business. So if we haven't done our market research properly, ineffectual market research will make cash flow forecasts inaccurate.
Show me.
Identifying cash flow problems, poor credit control.
Show me.
Lack of planning.
Show me.
Allowing customers too much credit. Now remember, offering credit is a marketing strategy as well. The more credit that you offer, the less likely your potential customer is going to go down to your nearest rival. Customers love credit.
Show me.
Rapid expansion. When a business expands rapidly, not only does it have to pay for the cost of that expansion, increase wages and materials that are needed in the production process months before it starts to receive cash from their additional sales. And unexpected events, unforeseen increase in costs. Perhaps your delivery van breaks down, needs to be replaced. Sales income falls below expectations. Perhaps a competitor has a massive sale. Now all these sorts of things can impact negatively on cash flows, causing problems. Now there are only two ways to improve cash flows.
Show me.
That's to increase inflows or decrease the outflows. We know that the cash in hand increases if cash inflows are greater than cash outflows. And the negative side of cash in hand decreases if our cash outflows are larger than our cash inflows. So we definitely want cash inflows to be larger than outflows. How can we increase cash inflows? How can we decrease cash outflows? So there are only two ways to increase inflows and decrease cash, to improve cash flows. That's to increase the inflows and decrease our cash outflows. How can we increase the inflows? Overdrafts, short-term loans, sales of assets, sell and lease back, reduce credit terms, get in some debt factoring, decrease in cash outflows. Main methods outlined now. Delay payments to suppliers, delay the spending on a capital equipment, lease equipment instead of purchasing it, decrease overhead spending. That doesn't decrease output. Another common IB business and management exam question here. So ways to improve cash flow, different ways to increase inflows, different ways to reduce cash outflows. I'm Mr. Burton, author of ibbusinessandmanagement.com. A pleasure to have you with me again today for this 3.3 working capital section in our accounts and finance topic. Join me next time for 3.4 if you're a higher level student, and we'll look at budgeting. See you next week.